Hello, this is Samantha Shares. This episode covers the OCC's Fall 2024 Operational Risk Report, focusing on cybersecurity, operational resilience, innovation, and fraud risk management. The following is an audio version of that document. This podcast is educational and is not legal advice. We are sponsored by Credit Union Exam Solutions Incorporated, whose team has over 240 years of National Credit Union Administration experience. We assist our clients with NCUA so they save time and money. If you are worried about a recent, upcoming, or in-process NCUA examination, reach out to learn how they can assist at marktreichel.com. Also check out our other podcast called With Flying Colors, where we provide tips on how to achieve success with NCUA. And now the OCC's Fall 2024 Operational Risk Report, focusing on cybersecurity, operational resilience, innovation, and fraud risk management. Cybersecurity. Operational risk remains elevated as cyber threat actors continue to evolve and refine their tactics by using more advanced technology, such as AI. Simultaneously, banking services continue to engage with third parties, including fintech firms, expanding the cyber-attack surface. Thus, the probability of occurrence and the potential impact of cyber incidents are increasing. This complex, interconnected operating environment amplifies the importance of third-party risk management, change management, and operational resilience measures. A financial entity's exposure to cyber threats and operational disruptions extends beyond its own network. Threat actors are increasingly targeting vulnerabilities and deficient security practices at financial service providers and their third parties. The OCC continues to see compromised systems involving the exploitation of publicly known vulnerabilities on Internet-accessible networks. This underscores the need for banks to maintain an inventory of assets and external connections and remediate vulnerabilities promptly. It is important that banks maintain effective change management and third-party risk management, including ensuring that third parties throughout the bank's information technology supply chain are adhering to secure software development standards to reduce the risk of disruptions or compromises. Additionally, it is critical that banks and their service providers have effective threat and vulnerability monitoring processes and security measures, including the use of multi-factor authentication (MFA), hardening of systems configurations, testing software updates before implementation, phased rollouts of software updates, timely vulnerability patch management, and immutable backups. The OCC continues to monitor the progress toward quantum computing capabilities and the associated risks to general encryption techniques. On August 13, 2024, the National Institute of Standards and Technology (NIST) finalized its principal set of encryption standards designed to withstand cyberattacks from a quantum computer. The new standards are designed for general encryption and digital signatures, which are critical to protect information and authentication. The process for transitioning to these new post-quantum computing PQC standards will likely take years to fully test and implement. Banks are encouraged to conduct inventories of where encryption is used within their operations and work with third parties to assess their PQC transition plans to ensure long-term security and interoperability. Institutions that develop their own software are also encouraged to begin the migration process. Operational resilience. An effective operational resilience strategy can enhance a bank's ability to mitigate disruption events, including cyber incidents, disruptions at third parties, change management issues, and other technology or operational outages. Operational resilience was highlighted in mid-2024 when a flawed software update at a large cybersecurity firm and weaknesses in change management programs caused global operating disruptions, shutting down systems across many sectors, including financial. Testing and validating operational resilience plans are appropriate to enable banks to respond to disruptions. Clear expectations should be in place for testing and certifying that a cyber event or other disruption at a third party has been effectively remediated. Validation and confidence are critical before reconnecting that third-party systems to appropriately mitigate contagion risk. Innovation and adoption of new products and services. Banks continue to adopt new technology and innovative products and services to further their digitization efforts and meet evolving customer expectations. Banks' incorporation of new technologies, including cloud computing and engaging with fintechs, may help banks of all sizes gain efficiencies and provide products and services to customers, often at lower cost and with enhanced customer experience. In addition to benefits, new technology and innovative products and services may increase the complexity of banks' operating environments, pose new risks, or exacerbate existing risks. Banks' increasingly complex relationships with fintech firms may increase the complexity of the operating environment and expose banks to a wider range of risks than traditional third-party arrangements. Effectively adopting new and modified products and services includes appropriate due diligence, enterprise change management, and risk management processes when considering changes to products, services, and operating environments. Assurance functions, such as audits, should be considered as part of planning, implementation, and ongoing monitoring of operational changes or increased complexity. Banks generally have approached AI adoption cautiously. Although AI and machine learning (ML) have been around for years in banking, new capabilities such as those arising from generative AI can present greater compliance and operational risks. Training large language models requires effective data quality governance. Many banks and service providers face challenges with maintaining legacy technology architectures while responding to these and other increasing digitization demands. It is important for banks to maintain an effective technology architecture strategy, commensurate with the size and complexity of products, services, and operations being supported. Technology strategies should include processes for managing and mitigating risks from technology assets that have reached their end of life. Banks considering or engaging in custody services for digital assets, including cryptocurrencies, holding stablecoin reserves, or participating in distributed ledger transaction verification should establish and maintain prudent, effective risk management practices. Some assets may present unique operational risks. Banks are reminded to follow OCC processes before engaging in certain cryptocurrency, stablecoin, and distributed ledger activities. Fraud risk management. As fraud targeting banks and their customers continues to increase, it is important for fraud risk management approaches to keep pace with a bank's evolving fraud risk profile. Effective fraud risk management includes reporting risk to senior management and the board on a timely, comprehensive basis. Additional considerations include confirming that control systems encompass both preventative controls to deter fraud and detective controls to identify and respond to fraud in a timely manner once it has occurred. Results of ongoing control testing should inform the redesign of existing controls, the implementation of new controls, and the addition of qualified staff, as needed. Effective customer identification and verification processes at account opening and appropriate monitoring throughout a customer's banking relationship are critical. Confirming wire instructions, verifying identity, and effective authentication controls are critical to preventing scams that are perpetuated using wire transfers. Verifying the accuracy of the transaction has caught and thwarted efforts to wire funds to fraudsters. Similarly, alerts and other messages introducing small frictions in P2P and other transactions could help consumers pause before making a payment to an unknown party. Identifying SARs on fraudulent activity in a timely manner remain important to protect both banks and consumers. Technology can help to flag suspicious activity, support prudent authentication, and block suspicious transactions until further authentication has occurred. Third-party risk management. Banks should guard against complacency and ensure that fundamental risk management practices, including third-party risk management, remain sound. Technological advances have continued the increasing trend of banks and trust companies outsourcing operations and entering relationships with third parties to deliver financial products and services. Effective management and oversight of third-party relationships are essential and generally follow a continuous life cycle. Third-party risk management processes should be commensurate with the bank's size, complexity, and risk profile, and the criticality of activities supported by the third party. A third-party relationship may expand or grow throughout the banking relationship. Ongoing monitoring activities should remain commensurate with the changes in the level and type of risk and any expanded use of services. Banks should consider interagency guidance. If your credit union could use assistance with your exam, reach out to Mark Treichel on LinkedIn or at marktreichel.com. This is Samantha Shares, and we thank you for listening.